we want to talk now about fixing rates out there in the wild at Sphere Home Loans. Are you doing much fixing, and what type of rates? I don't know if you've got them off the top of your head. Or
So I think...
okay, let's go. I want to do never make broad statements ever, because there's nuance in life. But if you were to say a broad statement, would you tell someone, and I'll put words in your mouth, spit them back out if you want, if your mortgage or your investment property mortgage has a 6 in front of it, and you've had that property for over 12 months, maybe go back to your broker?
Absolutely.
Okay.
If you don't have a 5
and the reason I said,
in front of it, go to your broker and ask for a review.
If it's been more than 12 months, because someone might have got a mortgage yesterday at 6.03, well, the property hasn't moved anything, and that's your rate. But if you've had a property for over 12 months, shouldn't have a 6 generally?
It definitely shouldn't have a 6.
Okay.
However, I would say, you said it's 12 months for a review.
Yeah.
Absolutely. But if you bought a house 4 months ago and you've had a comparable sale in your street that's going to say that your house may sell for more now and you're paying a higher rate, it's still worth a review.
Absolutely.
Because you've got that equity.
But I just, the broad statement is all, and that's why you don't make broad statements.
Yeah.
So based on that.
Coming back to fixing. I would say not a huge amount of people are fixing at the moment, but there are some. And it would be, like, if you're an investor with multiple properties, are you going to fix? Probably not, because you need to keep your portfolio fluid. And when you fix a loan, there's exit fees if you leave, if you pick up and move. So a lot of investors want to stay fluid. But if you look at a first home buyer or somebody who's got a fixed mortgage that they're going to be paying for a period of time, they know their plans, they know what they're doing. They may choose to fix not because they think they're going to beat the banks at their game of picking rates, but because they want the certainty of knowing what they're going to pay every week. So when we sit down and talk to somebody about fixing, it's not about, do you think the rates are going to be, am I going to save money by fixing? Because more often than not, you don't.
So the broad statement is, unless it's 2021...
that was an anomaly.
That's right. And that's why in 2021, you were fixing knowing that money ain't getting cheaper.
No.
And I'll beat the bank here.
Yeah.
But ordinarily, we're only fixing for personal certainty.
If it fit your goals to fix, if you go, well, even if rate, and the question that you tend to ask is, if rates went down, how would you feel about fixing?
Yeah.
And when someone says, even if they went down, I'd really prefer to fix because I want the certainty of what I'm going to pay every week, you're a fixer.
Yeah.
Get it done.
But also, it doesn't have to be all or nothing, does it?
It doesn't. And most people, when they fix, let's say you've got a $500,000 loan, most people would fix a percentage. They might fix 400 of that and leave 100,000 variable, so you can have all the flexibility to make additional repayments and things like that. But some people think if you fix a portion of your loan, you're saving the risk. You're actually not, because you've still got exit fees if you leave.
Okay, so just based on that, and maybe you can draw this for the people watching while I talk about it. Ordinarily, if you had a fixed loan of 500,000, you can't, and this is ordinarily, you can't pay down extra or exit that without the break fee, which is the baked in interest.
That's right. And there's some nuances in different banks that have the ability to make a certain amount extra.
An extra $10,000 a year.
Or some have some, but if you're going broad, you'd say that is a fixed loan. You can't pay too much extra and you're not going to have the flexibility of offset.
Yep. So then what you're saying is, if we set up a mortgage that was $500,000 total debt, 400 fixed, 100 variable, the question is, do you think over the next 5 years you can pay an extra $100,000 or more into paying down your loan sooner, and you probably have an offset account against that?
That's right.
If the answer is, no, I reckon the most we'll be able to do would be 10 grand over the next a year for the next 5 years, awesome, 100 grand, you've got plenty of room, so you can effectively pay down your mortgage sooner for that $100,000 split.
That's right. And for a lot of first home buyers, they use the variable split as their bite-sized chunk that they're focusing on paying off.
Yeah, yeah. And I'll ask another question about this when we talk about parental guarantees. But, I've said before on the show that my first home, it was scary, it was new, it was a $520,000 mortgage, oh my gosh.
Yeah.
that was scary and it was new for me. So I did a portion that was fixed and a portion, it was pretty much that loan setup.
Yeah.
And this is why it's like, as time goes on, you get used to it. I look back at hindsight, why the hell did I do that? It was cheap anyway. But you can't hindsight your own fears and because you're living in something for the first time. You're never not doing something for the first time. And that's okay.
That's right. And I may have a bias. Sometimes I have a bias towards variable rates, and I do that because I've seen people get caught.
The regret.
I've seen this where people come and they're getting divorced and they didn't plan to sell, and now they're getting $5,000 break fee on top of a really tough time.
Yeah.
Or they're upsizing their home, which should be a really happy time, and there's a fixed fee, and they didn't know when they fixed for 3 or 5 years that was there.
Yeah.
So I think as long as you go in with your eyes wide open and you know exactly what you're signing, you know what the risk is, fixed are great. But I probably see people on the other side a little bit too much, so I definitely have a bias to variable.
But that's the behavioural thing. Like me paying principal and interest on investment properties, most people would go, you're an idiot.
Yeah.
But I know, no, I spend money. It is forced savings. And it's like the analogy, of literally going through this ankle stuff at the moment. I was talking to the surgeon yesterday. I'm like, well, if you cut, will you put a moon boot on me for 2 weeks? And then he said, well, generally when you get the surgery like that, we put the back slab on for 2 weeks so the wound can heal.
Yeah.
Now, but he said in your situation, your skin's good. I wouldn't put a back slab on for the first 2 weeks because he needs to keep the ankle moving. But it's almost like surgeons will put the back slab on knowing that, the stitches will hold, but we're doing this as a behavioural thing so we can make sure you don't get in your own way and want to move and break the stitches.
Yeah, absolutely.
Dumb analogy. Whoa. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favour? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.